I'm going to start with, okay, got it. All right, so let's begin with a word of prayer. God and Father, we thank you for this opportunity that you have given us to come together as a church community and to talk about finances. We thank you for our presenter today, Mr. Loffredo, who is willing to devote his time to this. We ask that you just give him a special blessing for this. We pray that this will be a time that we'll be able to learn. It will be profitable, and we will be wise stewards so that we will be able to manage our finances prudently, and that we will be able to do it in a way that will bring honor to your name. So we commend this entire seminar into your hands. We ask that you would just bless it from beginning to end. And we ask this in the name of Jesus. Amen.
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 Alrighty, well, let me just say I want to thank everyone for coming on. We know others will be coming on. And we want to give a special thanks to our presenter today, Robert Loffredo. And I assume that Carol Ann will be presiding this evening. Am I correct?
Okay.
I didn't see a program, so I don't know.
Yeah, there's very little too.
Okay.
So,
You just let me know when I should start.
Yeah.
so Pastor, you could begin by reading his bio.
Sure. Okay. So it's up for all of us to see Robert Loffredo. Education, he received a MBA from NYU Stern School of Business, International Finance. Also received a BS from Manhattan College in Electrical Engineering. He attended Xavier High School. In terms of experience, he served as vice president, investments officer at Wells Fargo, Paramus, New Jersey. Served as financial consultant in Morgan Stanley. Certified financial professional. Certification from 1992 to 2021. Served as treasurer of the American Stock Exchange, the American Express. Prior to the American Express, worked in various positions for utility, international bank, major U.S. corporation.
Thank you, Pastor.
Okay.
Leo, you could take the bio down. Thank you. Thank you. Robert, you can begin.
Shall I begin?
Yes, sir.
All right. I see most of the questions are about the 529 plans. Do you have an interest in that, Marilyn?
I'm sorry. Can you repeat that?
Yeah, I see most of the initial questions are about 529 plans. Is that something you have an interest in? Or should I wait till other people come on?
I don't really know about it, so.
Okay. Okay, I'll start with the 529 plan. Basically, it's a tax-free way of saving for your child's education. A couple of years ago, you had to use the money for a college or university, but they have expanded that over the last 2 years to include vocational schools and even high school and elementary education. In general, without getting into some of the particulars, when your child is ready for college, any earnings that have accreted in the account, it's sort of like an investment account. So let's say you started when he or she was 10 years old. And so by the time they're 18, you're obviously going to need the money for college. All the money that was earned comes out tax-free. So as long as you use it for eligible expenses, which include room and board, tuition, supplies, computers. They're pretty lenient as to way you can spend the money. But usually I believe colleges send you a document at the end of the year notifying you what expenses were eligible, I think for tax purpose. So basically, that's what it's for. Now, the question comes in, and people always ask, so what if my child doesn't want to go to college? And let's say, so that's why they did expand it to the vocational or technical schools. Or basically any type of school that has to do with education. But let's say your child says, I'm done. I want to go to work. I'm 18. I want to go to work. I don't want to go to school anymore. Right, so the tax implications of that are, so if you put in $10,000 into a 529 plan, and by the time your child's 18, let's say it's 20,000, you will have to pay taxes on the 10,000 that was earned. That comes out as income, plus an additional 10% tax penalty.
Wow.
Yes, since you didn't use it for educational purposes. Now, if you have two children, you can move the money
Yes.
from the child who doesn't want to go to college to the other child. So basically you are in total control of the account. Now, you can leave the account as is and not take any money out, let's say, until you hope you have grandchildren.
Okay.
So you can wait all that time. You don't necessarily have to take it out, and then change the beneficiary to a grandchild. Or, and this is where it's very flexible. Well, let's say, Marilyn, your child doesn't want to go back to school, but you do.
Yes.
You can make yourself the beneficiary and use that money for your education.
Okay, that's good to know,
I didn't
Robert.
know
That
that.
was actually a question that I had.
Well,
Yeah. So the beneficiary is flexible. You can, if you want to change it to a nephew or a niece, you know, and support their education. And that's where you have total control. Versus what was common years ago before 529 plans were these custodial accounts, and we call them United Gift to Minors accounts. But I haven't opened one of those up in years, because the problem with that is, even though you don't have to use the money for education, there are no restrictions. In other words, the account will be titled Maryland Custodian for your child. When they are at the age of majority, in some states it's 18, I believe New York is 21, that money has to go to them. And they can go out and spend it all on that Corvette. You have, once they reach the age of majority, because it's basically a trust account, in trust for them. And when they're old enough, they can do whatever they want with that money, and you have no say over it. But that was the only way to save for a child's education years ago. Then they came up with the 529 plan, which is much better. You are in total control, and the beneficiary is flexible.
So for the 529, can you be the owner and the beneficiary?
Yes, I have a couple of clients where they are the owner and they are the beneficiary because they decided to go back to school.
Okay. Okay.
That's good plan.
Yeah. Now, let's talk about every state in the United States has a 529 plan. So initially I would go out and look. It didn't matter whether the plan was a plan that was instituted in Arizona, New Hampshire. What you were looking at, who was managing the plan and what their performance was. Now, for instance, if as a resident of New Jersey, I found that the best plan was managed by John Hancock out of Alaska.
Hmm.
You could invest in that plan, but a lot of states allow you to deduct your contribution to the plan from your taxes, particularly New York. So it would behoove you then to open up the New York State plan. And let's say you make a contribution of $2,000 a year, that is deductible from your taxes. So a lot of states have caveats where some states will allow you to deduct the amount you contribute, no matter what plan you're in, anywhere in the United States. New York specifies that you need to be in a New York plan. So all of my New York clients are in New York plans because when they make the contribution, they can deduct it from their taxes.
Hmm.
All right, so
Is
all
there
the
a is there a maximum deduction that
I think New York is 10,000 a year.
okay.
They'll allow you to deduct 10,000 a year. So I have clients that just contribute 10,000 a year and that's it.
Okay.
All right. Now, what are the plans invested in? They're usually in mutual funds, and you're limited to what that plan offers as investments. And that's why we go out. If you're not in a state where you're able to deduct your contribution, you can go out to any state, find the best plan, and invest in that plan. The plans, since they're invested in mutual funds, and you have no choice but to select the mutual funds they offer, obviously can be risky. In a downturn, those funds will go down, and in an upturn, they will go up. So that's why it's better to start, like in any investment, in the 529 plan when your child is young. Because they have the time. They have, let's say you start when they're 1 year or 2 years old, they have 16 years ahead of them. And yes, any downturn, any upturn will average over time, and you'll more than likely make out with the balance. So it is a risky investment. The problem these days is that years ago, you could have, let's say you had a stock portfolio, and you could have told me, I think the market's going to go down, sell it all, and buy me that CD for 6%. Well, if you notice today, and over the past 10 years, CDs haven't been paying anything. So if you need income, you have to go to the stock market and buy and look at a stock that has a dividend so you can receive some income. So it is a little, you're in a quandary these days in that you can't, if you're looking for a certain amount of income per month, it's no longer there on the bond side or the Treasury side because they're not paying anything. They're paying less than 1%. But I'm going off track a little. All right, so one of the questions was, how much should I save each month towards college, right? Well, if you assume that by the time, and this probably even includes state schools, you're probably going to need anywhere from $250,000 to $300,000 by the time your child, depending how young they are, reaches college age. But I have a lot of clients that panic about that, and I say to them, so they focus everything on putting money into the child's education without putting money into their retirement needs. And then the time comes sure, you have enough money for the child's education, and then you look at what you need to retire on, and you're going to be way short. So it's a balancing act. I tell my clients, first of all, you should think about retirement. And in order to do that, the earlier you start saving for retirement, and we can go into different ways of saving, but let's look at saving for retirement, because you need some type of nest egg when you retire. As far as, I wouldn't worry about making sure you have your child's full education paid for, whatever is not paid for. There are loans out there. There are grants, there are scholarships, there are other ways of making up for the balance. A typical example, when my kids were ready for college, I only had about 1.5 years. So you do what you can. I was selling my CDs, putting money on the mortgage, etc. So more importantly, it's about your retirement. Yes, put some money away if you can afford to for your child's education, but you should be concentrating on your retirement first. And that's a big mistake people don't realize. And by the time you're ready for retirement, you don't have enough money to support yourself. Any questions so far?
Robert, what about years ago, you were able to buy the triple E, double E bonds through payroll deductions, but it seems as though that dropped out.
They don't exist anymore, yeah.
Oh, they don't exist? So you couldn't actually go to a bank and buy those bonds anymore?
No, not anymore. They're gone.
What about the treasuries? Can you buy those? And how do you buy those?
Well, you can buy the treasury 2 ways. You can go through a broker like myself, or you can buy direct from the treasury. My father used to buy them directly from the Treasury Reserve. You open up an account there.
Hmm.
But treasuries are paying less than 1%.
Wow. Wow.
That's the problem on the fixed income side. CDs, treasuries, anything that's safe and secure, because it's safe and secure, is not paying anything. And that is why there's so much volume in the marketplace, because the only way to earn some type of return, whether it's dividends, interest, is to be in stocks.
And that's volatile because
Yeah, and I guarantee you, Murphy's Law,
yeah,
when you need the money,
it
the
won't.
market's going to be down. I can almost guarantee that. It never works when you need the money. The market's going to be up. All right, so let's move on, and let's say if your child gets a scholarship and you have the money in the 529, you only have one child, you're able to take the money out up to the amount of the scholarship without penalty. You still have to pay regular taxes on the earnings, but there's no penalty. Now, they've also expanded the what you can use 529 for is if your child has a loan out for his education, you can use the 529 proceeds to pay some of the loan.
Some? Why not? Is there a cap?
I had yeah, it's only up to 10,000.
Okay.
But still, it's the way.
10,000 a year or 10,000?
No, it's a lifetime, 10,000 max.
Oh, max. Okay.
But it's a way to use some of the 529 without penalty also. Like I said, how much should I save for my child's college expenses? Whatever you can afford, without hindering what you can save for your retirement. That the 529 or the child's education should be secondary. Obviously, you'll have to file when the child is ready for college. You'll have to file a FAFSA application. What you basically have to be penniless. I mean, to get any money from FAFSA, if you're making 26,000 or less, you will get 100% of what they decide you should get. If you're making, I had a number here, it was actually ridiculous. You're making 60,000 or more, you get nothing. So then you have to go to grants, which are, there's no payback on a grant. If you get a grant from the college, you can do work study, you can do loans. So there's ways of supporting your child's education without going bankrupt.
And what about if the child claims independent? I know a lot of kids.
Yeah, now you can, yeah, here's a little trick that people do. But it depends on the child also, you know, how mature they are or independent they are. Because basically being independent means you're not going to take the child as a dependent on your taxes anymore, right?
Right, right.
So they're on their own. Now, what my daughter-in-law did, she went to the University of Kentucky, but she declared her independence. So it's a state school, so she would pay the in-state tuition rather than the out-of-state tuition. And what she did was she changed her driver's license to Kentucky, got a little part-time job, set up residence there, so she wouldn't have to pay the out-of-state tuition for state school. She paid the in-state. So basically being independent means you no longer support them and they are off your tax form. All right. But it takes a certain child to do that. I mean, I would think they'd have to be a little mature and basically willing to go on their own. I mean, that doesn't mean you're not sending the money on the side, but you know, but that's basically just to get into a state school that's out of state.
Gotcha.
All right. Yeah.
And what about the Excelsior program? Wasn't there like 150,000 max income that was associated with the Excelsior program?
Say that the Excel?
The Excelsior program was supposed to provide free tuition to parents who make a certain amount of income, but I think it was more than the 60,000.
Oh, I have to admit, I'm not familiar with that one. I'm sorry. Where did you hear that one?
Yeah, that's part of state college programs where if you go on the site Excelsior program, I think that last I checked on it, I haven't checked on it in a little while. It was about, I think 150,000 was the max. 100, it was 100. It was supposed to increase each year. I think the max was supposed to be 150 for the parents to be making to qualify for state college tuition. Again, I haven't checked the latest, but
yeah. Is that something new? Because I'll have to look that up. You know, I'm only familiar with the Pels or the FSCOG, work study loans and scholarships. How do you spell that? I will look that up.
I think it's EXCELSIOR, something like that. I can double check.
Oh, Excelsior.
Yeah.
Okay. Wow. Okay. I was unfamiliar with that one.
Okay.
Sorry about that. Yeah. The thing with, I guess, the FAFSA form is that when you're ready to fill out that application, it's actually, even though you're filling it out, it's actually the child that's responsible for it. So what happens is any of the parents' assets are qualified at around 5%, and the child's around 20. So you want to make sure the child doesn't have much money in his name, although he or she is able to have an account of at least $6,600, which wouldn't count. So that's one of the positives of the 529 plan, because you are the owner as the parent. So your assets only come in at around 5.5%. FAFSA does not include 401k plans or any corporate plans that the parent has. And it doesn't include IRA plans or any type of retirement plans. So that's an additional issue which you need to be aware of. It's still the best thing out there as far as, if you're, certainly if your child is serious about moving on with their education. But like I said, they've expanded it that you can use it for high school and grammar school education, vocational, technical, anything that has to do with education. So even just taking a couple of courses without getting a degree would qualify.
That's interesting.
Yeah, years ago it was very restrictive. It had to be for college or university, but they've changed that. And it used to be also a couple of years ago, their grandparent, the child's grandparent, could start a 529 for them. But since they weren't it wasn't their immediate child, when the grandparent paid for the education, it was a benefit to the child. So he or she had to report it on the FAFSA application. But they changed that also, that any whether it's a grandparent or a parent or an uncle, an aunt or an uncle, if it's for the child, benefit of the child in their education, there's no tax ramifications.
Robert, what about, they have an instrument, I think it's governed mainly by the American Century Gift Trust Fund. You put X amount of dollars. Years ago, you were able to put on a monthly basis, but now you have to put in a lump sum, whatever that amount is. And they basically invested in growth type stocks, mutual funds, I guess. And that money stays there and grows for an 18-year period. And after that 18-year period, then that money is turned over to the child. Are you familiar with that type of?
Well, if they're going to turn it over to the child, somebody's going to have to pay taxes on the earnings. I mean, that sounds to me like what we were talking about, the United Gift to Minors Trust, where you put the money in, and at the age of 18 or 21, I think it's based on the age of majority of the state, the child gets that. But in the meantime, every year, you have to report the earnings on that account and pay taxes on it.
It's not so, as I recall it, it's not so much that the child's age, it just has to stay in that type of account for 18 years.
Yeah, they're telling you 18 years, but that's similar to the, again, the United Gift to Minors Act, where it has to be, it doesn't have to be in for 18 years, but it behooves you to keep it in for 18 years. But like I said, similar to, I don't care what they call it, let's say at 18, that money goes to the child in the child's name, and he or she can do whatever they want with it.
Yeah. But who's responsible for paying the taxes? The owner or the person that you gift it to?
No, the owner.
Ooh, okay.
You're not gonna, these days, the government has the tax laws pretty locked up. You're not gonna get away from not paying taxes.
But ultimately, the money went to the child, not to the person that owned the account.
That's how I mentioned and they're still around, these trust accounts, the United Gift, because you would gift money into the account because it was a trust account, and at the age of majority, we have to legally turn over the money. And we had a lot of those old accounts, and at 21, actually, we had to change the account into the child's name, and the parent had no more control over it.
Yes.
So if you trust your child and you figure they won't squander it, that's fine.
Does the child have to know that money has been turned over to them? Do you?
Well, they don't know. They don't have to know that you set up the account, but once we turn it over, it has to be an account in that child's name. And yes, they will know.
Mm.
Well, you can always show them the will and say, do you see your name in the will? But anyway, okay. But even in a 529 plan, there is risk because you are invested in mutual funds.
Mm.
And, over time, the market will go up or down because the mutual funds are invested in stocks in the market. So there is a risk there also. All right, we talked about, now there are some states, like I said, that there's quite a few states that offer some type of tax benefit. Most of them, ironically, are in the South.
Mm.
Like the best thing would be a state offering a deduction on your taxes, and you don't have to be within their state plan, but they're all in Arkansas, Kansas, Missouri. Oh, there's one in Montana. So there's quite a few different. Some states will give you a percentage of your contribution as a credit. Some will give you the tax deduction with any plan, but there are some like New York where you have to have the state plan and live in the state of New York.
Is that also true with Delaware, that they give you a really good tax break in terms of federal taxes?
I don't have, well, not for 529 plans, but yes, for federal taxes. For instance, we're going off here a little. There are states that don't tax your pension.
Mm.
And I've had some clients move to those states, although I would never move to those states. I know one client I had moved to Alabama because they don't tax pensions. I think Florida is another one. But, it's kind of interesting. I've had clients move out of state, and yet where they had all these tax benefits, and yet they come back and tell me that everything's expensive in the state.
Right. And that is definitely true for Florida.
Yeah.
A lot of people move to Florida, but don't realize that the healthcare benefits and a lot of the other benefits are just not there.
Yeah, I'm trying to go through the list here to see. Yeah, New York will give you a deduction each year of 5,000 if you're single and 10,000 if you're married. Yeah, let's talk about some other options there are if you don't want to do a 529 plan.
Right.
All right, so obviously there's savings accounts. There's no restrictions at all on what you can spend the money on, but there's hardly any return these days. Probably from what I see from the banks having the savings account, you're lucky you get probably, I don't know, 0.3, 0.5%. So that's not really a way to save and have your money grow. You can open up a Roth IRA. The problem with Roth IRAs, depending on your age, you need to hold it for 5 years, and then you can withdraw without penalty after 59 and a half. So let's say you started a Roth IRA about 6 years ago, and you're 60 years old now. You can withdraw from your Roth tax-free, and maybe use that money to pay for some of your child's education. But you do need to hold it for 5 years, and you need to be at least 59 and a half before you take it out. You can open up a brokerage account, but there's absolutely no tax advantages, and it could be risky. If you do open up, decide that you're really unsure about education for your child, you still can open up one of these Gift to Minors Act accounts. And some of the advantages tax-wise are the first $1,100 that the account earns is tax-free. The second $1,100 goes off at the child's rate, which is probably negligible. But anything above that goes off at the parent's rate, but there are no restrictions. And the downside to that is at 18 or 21, the money has to be turned over to the child. They do have educational IRAs, but they are limited. You can only contribute $2,000 a year. And if you make a certain salary level, you can't contribute to them at all. So I don't know anyone that opens up an educational IRA these days. You can interrupt me at any time. Any questions before I go on? No? All right, let me see. We said penalties for early withdrawals. Okay, 10%. Well, that's the IRA. Oh, we'll talk about that later. States that have, all right, 529 benefits. What should I consider? So basically, when you look at a 529, basically you want to look at if there's no state tax deduction, you want to go across the 50 states and look at what some of the best plans are. And that's what I usually do when someone comes in, let's say from out of state, and they want to open up a 529. I will look at all the states and their 529 plans are, what they're invested in, who manages them, and what their returns have been. We talked about if it can be used only for college or university, no, for elementary and secondary. We talked about if the child does not go to college, can it be used for a trade school? Yes. How much should I save each month? Like I said, that depends on you. There is no fixed formula as to, but the goal, and it's a, it doesn't have to be reached. If it's going to put some sacrifice on your side, the goal is to have at least 200,000 to 300,000 in there, depending on by the time they're ready to go to college. If he gets a scholarship, you can take that amount of the scholarship out without penalty, but you still have to pay taxes on the income. Your other options, like I said, are limited, but probably the Roth IRA savings account will give you nothing. Probably the Roth IRA is the only other way to go, or these United Gift to Minus accounts. But then again, at 18 or 21, the money is the child's. Is it a good idea to invest in stocks for education? All right, that's a good one. All right, so if you open up a 529 plan, you're limited to what the 529 plan offers. And all of them only offer mutual funds. Now, is it a good idea to invest in stocks for education? So you would have to open up a separate account, a brokerage account separately, pick some stocks, either that you're knowledgeable of or some will advise you on. And the market over time, even with the downturn in 08 and 09 when the market crashed, the market over time will give you a return up and down, if you're in it long enough, about 6%. It's the only way to achieve growth, but it is risky. Most clients will open up a 529 and open up a brokerage account where they'll invest in stocks, both. But the brokerage account, as you well know, with the economy and the stock market, it will go up and it will go down. if you can bear the risk mentally and sleep at night, yes, it's a good idea to invest in stocks, particularly ones that offer you a decent dividend. And there are quite a few large companies out there that, and names you would be aware of, that offer anywhere from a 3 to 4% dividend. So there's a nice return for you. And stocks with dividends mitigate a downturn in the market. So let's say the market goes down 5% and you're getting a 3%. So your stock goes down 5%, but you're getting a 3% dividend. So you're only going to be down 2%. But it is risky. Yes, most clients have both a 529 and a brokerage account.
Now, you mentioned investing in stocks. If I remember correctly, stocks can come like in two flavors. So you have the regular stocks and you have the preferred stocks.
Yeah, preferred stocks are more like bonds.
Right.
They give you a fixed return, but no growth. So when they, I'll say mature, they usually last 5 years. You get the face value of the preferred stock, which is $25. You get the $25 plus, but in 5 years, you're earning that interest, and that interest is fixed whether the market goes up or down. They cannot change that coupon, wherein a stock that listed on the American Stock Exchange, everyone thinks the dividends are guaranteed. And that's absolutely incorrect. The dividends are guaranteed when the board meets every quarter and says, we're going to pay the dividend. But more than likely, the blue chips for years, we've never had an instance where they said they weren't paying the dividend. But yeah, but it is a preferred stock. We call it a hybrid. It acts like a bond and trades like a stock. For instance, there's a JP Morgan preferred stock out there paying about 5.5%. So you will continue to get 5.5%, whether the initial price of the stock, which was $25, goes down to, I'll exaggerate, $15. You will still get the 5.5. And at the end of the 5 years, no matter what the stock is trading at, they have to pay you the $25. But in the meantime, since it acts like a bond, it's not affected by the stock market, it's affected by interest rates. So when interest rates go up, the price of the bond goes down. So with anything, including treasuries, if you own treasuries, they are guaranteed at maturity, but from the time you purchase it to maturity, that's not to say the price that you paid is going to be, the bond is going to go down to less than what you paid. It will fluctuate.
I noticed you mentioned investing in stocks. What about investing in bonds?
Bonds are fine, but as I mentioned in the beginning, they don't pay anything. Even on a tax exempt muni, you have to go out 10 years to earn 1%.
Wow.
So I don't even look there anymore. But I'm looking at let's get back to I can talk about investments in IRAs later.
Okay.
Okay, it says here, should I take I think there was a question here. Should I take money out of my 401k to pay for my debt? Let's say you have a mortgage, assuming. I know there was that question here. My answer to you is absolutely not. When you take money out of your 401k, it's 100%. First of all, it's 100% taxable. All right. And then you lose, that's basically your retirement nest egg. When you now you can take it out as a loan, and while you're working, pay it back. It's automatically deducted from your paycheck. But you're taking that, because if you don't take out a loan and you take out a certain amount lump sum, that's 100% taxable income. So you don't want to do that. So you would have to take a loan from your 401k to pay off a loan. It makes absolutely no sense. And then depending on the amount you take out, if you're not at work long enough to pay it back, you've lost all that money for your retirement. I don't know if that makes sense. So you never want to, you really want to preserve any type of corporate retirement plan. And how much you should invest in the plan, you should invest if the company matches your contribution up to, let's say, a certain percentage, whether it's 3 or 6%. Let's say they match 6% of whatever you put in. At a minimum, you should put in 6%. They will double that, but an additional 6%. It is free money. And where else can you get 100% return on your money?
Mm. Mm.
So think about that. You should never invade your company retirement plans.
I was about to do that, but my 401k.
Any particular reason?
Because of that not working right now. And I called in and they told me, well, one thing is that they said that I won't get penalty, but if I take the money, whatever money, I have to pay taxes.
Yeah, 25. What they will do is they'll automatically deduct 25%.
Mm-hmm.
Yeah.
And then when I calculated the taxes, and I said, well, it's almost $1,000 just in taxes. Yeah. And then I said, would I have to ask for more than what I needed? So I just left it like that. So I'm glad you went over that.
It's never a good idea to invade. You're going to pay dearly for it unless you're able to put it back over a certain amount of time.
Okay. So what happened now that you're not working?
Well, they'll just hold it there for you. There's no reason unless they notify you. But you've been laid off, or do you have the opportunity to go back? Let me say.
Well, when we the company closed because of the pandemic. At some point, we were expecting that we were all going to go back to work. But now, the company opened not too long ago in April, but my understanding that not everybody's going to come back to work, and because it goes by seniority. So since I am one of the last one, I don't believe I'm going back to work. So technically, I'm really not working anymore with the company unless they call me back.
Okay. Well, you can reach out to them unless they've reached out to you already to move the money. The best way to move it is to set up an IRA account in your name.
Mm-hmm.
So it goes into the IRA without taxes or penalties. It's just a transfer from a corporate tax deferred plan to an IRA, which is tax deferred. If you transfer everything into your name, yes, you have to pay taxes. If you transfer it into an individual retirement account, which are very common, I have a couple myself. There is no tax effect. There's no reporting. There's nothing. And then it becomes money in your name. It's not the company's corporate plan. Bear in mind, though, that and then you can take the money out, but you'll have to, some of the money, all of the money, none of the money, but anything you take out from an IRA goes to the top line on your taxes as income.
Okay.
But that's a way of transferring it into your name. If the company is not going to operate anymore, yes, but if they haven't notified you yet, and sometimes, like my wife is retired and her money is still at the company because the investment provider at the company is basically stellar, and she, it depends what investment options they give you within the plan. Some are horrible, some are great. If it's a great plan, I would keep it in there until you're ready to move it to an IRA. So it depends on who's supporting the plan also.
Okay.
Lauren, I see you have a hand raised. I see someone by the name of Lauren. I see she has a hand raised.
Hi, good evening, everyone. It's Wesley Carroll.
Oh, okay. Hi, how are you, Wesley?
I have a question.
Sure.
I'm already retired 2 years and I have a 401k. And before I left my employment, I borrowed from my 401k, but now that I'm retired, how would I access my money without paying so much tax? Because the amount of money that I took out of my account, it was like ridiculous tax I paid on it. So how am I to go forward in terms of withdrawing from my 401k?
Yeah, do you still have a loan outstanding with the 401k?
Yes, I do.
Okay.
But I'm retired now, so does that matter?
No, you can leave it there, but if usually the firm will contact you and say, move the money, right?
But isn't it the age factor? Isn't it, because I'm over 59 and a half, so I'm not penalized if I take it out. But what I'm trying to prevent is all the tax, because I recently did my taxes, and I'm being forced to pay taxes on money that was already taxed, because the money that was I used, they took out the initial, I think it was 25% or 20%, and now I'm paying taxes on it again. How can I alleviate that?
Well, you should know what happens is, okay, so they sent you a check, right? Basically,
Right.
Less the 20%, I believe it's 25. All right, so when you file at the end of the year, let's say you took out, I don't know, 50,000. All right. You have to report the 50,000 as income. It gets melded in with your other income and deductions within your tax form. Then at the end, the tax, let's say that you owe 30,000 in taxes, but you've already paid 25, you're still going to owe 5. It gets melded in with everything else on your 1040. And then at the end, let's say you only owed 20,000, even with the withdrawal from the 401k, and you pay 25, you'll get a refund of 5. All right. So if you want it out of the corporate plan, you would have to transfer it again to an IRA, but they will.
But I'm not certain if my plan is a corporate plan or are all 401k. I work for the state of New York. So
403B, or what is it? A 403 something, right?
Isn't it 457?
457.
Is it?
Well, anyway,
457B?
I'm not certain.
Yeah, it doesn't.
Considered it.
The plan is if you move it and you can move it to an IRA, they will move net of what you owe. They will. So let's say you have 100,000 in there and you owe 50. You will only be able to move 50 to your IRA.
Okay. And then once it's in my IRA, I'm able to take from that without being penalized so heavily in tax.
That's correct. You can take it out piecemeal over the years. You don't have to start taking that out. They extended the age to 72. It used to be 70 and a half was mandatory. Now it's 72, so you can leave it in there if you don't need it. But if you do take it out, it's all pre-tax. Your plan was pre-tax. Let's say you take out 1,000 each year, you will have to report 1,000 in income each year.
See, my
But
pension.
but no penalties.
I see.
At
Okay.
70,
Yeah. Go ahead.
at 72, do they give you a maximum or a minimum that you have to
No,
take?
a minimum.
A minimum. So what is that minimum?
Well, it's an actual actuarial table based on your life expectancy that the IRS has.
Uh-huh.
It actually goes up to 115. And the first amount, let's say there's 50,000 in your IRA when you're 72. The first amount, the factor is 25.2, so 50,000 divided by 25.2. You will have to take out 2,000. Now,
Yearly.
no, it goes up every year.
Oh,
Because the older you get,
the more they want you to take
the
out,
more you have to take out.
they
Because
expect you to die soon.
the idea is that by the time you reach your life expectancy, your IRA account is zero, and the government has gotten all their tax money.
Ah,
So when you look at the calculation, it's a very simple calculation based on the table. It's based on every year what the IRA is worth, divided by a number. And when you think of it, as you get older, that number that you divide by gets smaller and smaller. So it goes from 25 to 24 to 22 to 21. So if you're dividing by a smaller number, you have to take out more.
okay. Makes sense. Okay, thanks.
But it's not what you want as you get older, that you're paying more taxes
Right.
because you're taking out more.
Mhm.
I'm trying to find out here.
And it's once you take this out, do you have to file an income tax? Is there a limit as in terms of the income that you get yearly where the IRS mandates you to file an income tax?
Yeah, I believe it's it's over I'm not sure the amount. It might still be that 20, I think it's 35,000. I'm not sure.
Okay.
But if it's less than that amount, you don't have to file.
Okay.
But let me, I've been recommending, depending on, we can, I guess, any more questions on education? I'm trying to look at the questions here. See if I missed any. Let me go down the list. Okay, 529s, that's a scholarship. Oh, do you need to take out a loan for your child's education? Should it be in my name or my child's? You never want to put your name on it. Only your child's. Because if they can't pay, they're coming after you. So never. I've seen too many bad cases where that has happened. Okay, what if my child goes to college and does poorly? It doesn't matter as long as he's in college or transfers to a trade school or community school or whatever, you can still use it. If he leaves college, you know, like we had mentioned before, you can change the beneficiary, or you can leave it in there hoping you'll have grandkids one day. There's no reason to take it out immediately. And if you do, you just have to pay on the earnings and an additional 10% tax penalty. So I think we've covered 529s. Any other questions on 529s? Okay. Earnings. But grant, yeah, I think that's all there is. But like anything else, you are invested in the market within the 529, and there is some risk involved. All right, shall I talk about IRAs?
Yeah.
Okay. So you can, even if you're working, you can contribute to an IRA up to $6,000 a year. If you're under 50 years old, if you're over 50, you can put in another 1,000, so that makes it 7,000 a year. Now, there are differences between the traditional IRA and the Roth IRA. The Roth IRA, as I mentioned before, you have to be in it 5 years, and in order to take it out, you have to be over 59 and a half. So if you're, in your 50s now, I would recommend opening up a Roth IRA. You can contribute up to $7,000 a year. The only caveat is that, and then let's say you contribute $7,000 a year, and let's say by the time you're 70, you have, I don't know, 80,000 in the account. You can take the full 80,000 out without paying any taxes. So Roth IRAs, you're contributing with after-tax money, so you're paying your taxes now, not later. Traditional IRAs, you are not paying your tax now, you're paying it later when you take it out. The only problem with Roth IRAs, if you're single and making 140 or more, you cannot contribute. If you're married filing jointly and you make over 208, you cannot contribute. Traditional IRAs, there is an income limitation if you want to deduct the contribution from your taxes. You're allowed to deduct the contribution from your taxes if, let's see here, you make less than $66,000 a year. So if you make less than $66,000 a year and you put $7,000 into an IRA, you can deduct that $7,000 from your taxable income.
Okay.
The problem with IRAs, because at some point, let's say you're making more than the limit on your income that allows you to deduct. You can still contribute the $7,000 to your IRA without being able to deduct it for taxes. The problem becomes if you've started an IRA and you were making contributions and deducting it from your taxes, and then you contribute to the same IRA where you're not able to deduct the contribution, there's a complicated formula that says how much of that IRA is taxable and how much is not, because you contributed with after-tax money. When you contribute anything with after-tax money, they can't tax you again. So there's a complicated IRS formula, and you have to keep track of how much you put in and deducted from your taxes and how much you put in and did not deduct from your taxes.
Wow.
That is a nightmare in itself. And the only way around that is to open up a second IRA. So if you have an IRA and you're contributing with money that you're deducting from your taxes, and then you're no longer, because of the salary limitation, you're no longer able to deduct, you can open up another IRA and contribute with the after-tax money. So at least it's clean You have one IRA that you will have to pay taxes on because you deduct it from your taxes. Then you have the second IRA where you won't have to pay taxes on the contribution, just on the earnings.
Mm.
I hope I didn't confuse the hell out of you. Excuse my language, Pastor.
Of course you did. Of course you did. You open one to shake this hand, you open another one to shake another hand.
Now,
That's why we have to pay you the big bucks.
yeah, right. All right. Now, the good thing about IRAs, whether they're Roths or traditional, you can use them for higher educational expenses. So you can take the money out and just pay taxes on what's owed, and there's no tax penalties, and you can pay for your child's higher educations. Or if you're a first-time home buyer, let's say you've been renting for years and you want to buy a home, you can take $10,000 out without the tax penalty. You always have to pay income tax, but there would be no penalties. And then there's some other caveats that if you pass disability, medical expenses, insurance premiums. I understand disability, though, is very difficult. I forget, I gather you would not be able to work. There's a Medicare or Medicaid definition for disability, which I think they go with. Again, you can leave it in. What's nice about it, it gets tax deferred for years. If you don't need it, hopefully it will continue to grow. And most of the time you can, within the IRA, you can invest in bonds, mutual funds, stocks. It acts like a brokerage account. And hopefully it would grow over time. The problem with IRAs, if you're in stocks, if you have a gain, fine. Let's say you have a stock in an IRA, you want to sell it and you have a $1,000 gain, nothing is reportable until you take money out. But if you have a $1,000 loss, you can't take that benefit either on your tax return because it's all inside the umbrella of the IRA. And the IRS is only concerned with the money you take out, and whether it's a gain or a loss within the IRA, the money you take out is considered income.
So talk to us a little bit about capital gains.
Okay, which is something on the table in Congress right now, although I don't think it will go anywhere. Capital gains get taxed at a lower rate. So what happens at the end of the year, and it only refers to taxable accounts like a brokerage account where you might have a number of stocks that you've bought and sold during the year. So you would net your gains against your losses. If it's a net gain, you would pay tax on the gain, but there's a separate calculation for capital gains or losses on a separate tax sheet, and the rate is much lower than it would be for your personal income tax rate. And depending on what your income is, the gain, let's say you have a net gain, the gain could be taxed at anywhere from 0 to 15%. Losses, you're allowed to take over and above the net, you're allowed to take $3,000 in losses each year for tax purposes. And for instance, at the end of the year, I'll get calls from clients and they'll say, find me $3,000 in losses. So they can deduct that from their income tax.
Is that legally? I mean, did they?
Yeah, that's legal.
Okay.
So you can, and to give you an example, if you have 50,000 in, I don't know, gains and 50,000 in losses, obviously the net is 0. So you would call me and say, find another 3,000 in losses. So you would have 53,000 in losses and 50 in gains, and you could take that 3,000 and deduct it.
So where are you finding it from? if it didn't actually.
Well, hopefully you have some losses in your account.
Okay, okay,
We're not perfect, so
okay.
it is volatile. And I do have some clients that have no losses, and I say, well, that's impossible. That's not going to happen.
Mm.
Okay. We talked about penalties for withdrawals of states which have no income tax. Someone asked,
Yes, yes.
one of your parishioners live in Texas? Because it says example, Texas, where I live.
Oh,
No?
I think
Oh, who's that?
I think that was I forgot her name, Beckford.
Okay.
That must be a friend of yours.
No, actually, she's a friend of yours. I forgot her name.
Whoops.
Pastor, Pastor, I hope she's contributing.
I
Okay.
forgot her name, but
Send her that
Texas?
envelope every month. Yeah, there are a number of states that have 14 states have no income tax, obviously. Florida is one of them, Nevada, you probably heard about them in the news. Alaska, Tennessee, well, there's 14 states. There's also an additional 1, 2, 3, 4, 5 states. Not only do they have no income state tax, but they don't tax your pension.
mm,
And that's Alabama, Illinois, Hawaii, Mississippi. So I have a lot of clients that'll move to those states for those specific reasons.
wow.
Yeah, that's a tough move. But anyway. Okay. Before I go on, anyone have additional questions? Please interrupt me while I'm talking. No? Okay. Investing in gold.
Yes.
Okay. 2 ways to do it. You can actually buy gold bullion. I don't know where you're going to put it in your house, but usually you would have someone store it for you, an organization, and it would be in your name, but there's insurance costs, there's the transportation costs. That would be the only way years ago you could buy gold. You'd have to buy the actual gold and hold it somewhere. These days, though, you can easily buy gold in the stock market without having it delivered. There are, we call them ETFs, exchange traded funds. And there's the gold ETF, and all it does, it's supported by State Street Bank in Boston. They actually hold gold, so they could offer this investment vehicle to you without owning the gold. And all it does is follow the price of gold. So if you own this security, when the price of gold goes up, it goes up. When the price of gold goes down, it goes down, and it's a 1-to-1 factor. So if it goes up 10%, if gold goes up 10%, your security goes up 10%. So it's a much cheaper way of owning gold without actually owning the actual mineral itself. And State Street Bank is the one, when you buy this ETF, it's the one that holds the gold for you. And they pay all the costs, insurance costs, depository costs, and everything else. So you can do that with silver, you can do that with gold, you can do that with platinum, where all these ETFs, and it's a much cheaper way of going the gold route or any of the mineral route without actually holding the actual gold. And obviously, if you hold the actual gold, it would take time to sell it, deliver it, sell it, where these act like a stock, so you can trade them immediately in the stock market.
Mm-hmm.
You had a question, I guess, and all of my young clients are trading on Robinhood.
Yes, yes, Robin Hood for the millennials.
All right, Robinhood is just a trading site, similar to Fidelity or TD Ameritrade. The thing about Robinhood is that, I guess like Charles Schwab, you can buy fractional shares of stock. There's no commission on trades, but the reason these kids are on it is that you can buy Bitcoins.
Yeah, that's another question. How about
You can buy and sell Bitcoins on Robinhood without actually creating or holding a Bitcoin.
is that the only market, or
No, you can go to, you'd have to open up an account at Ethereum. You can go to Coinbase. There's quite a few markets out there where you can buy and trade Bitcoins. Yeah, that's the fascination these days with Robinhood. And there seems to be a network of traders that have developed on this site. We call them, there's another site called Reddit, REDTIT, where all these young traders get together and pick a stock to buy. And if you've seen some news lately, let's say about GameStop or AMC theaters, they have been skyrocketing
yes,
because all these traders, these young kids, have decided to fight the hedge funds, where the hedge funds years ago could start selling that security and drive the, if they didn't think the numbers were there, drive that corporation out of business. So it seems like these Reddit traders are finding out where the hedge funds are shorting or selling mass amount of stocks in a particular company, and they are buying it.
wow,
So they're fighting them, and the stock is up. And what happened to GameStop about a half a year ago, the stock was trading at below $10 a share. It's now trading up over 200. A couple of hedge funds, and they were correct. The numbers weren't there. GameStop should have gone out of business. This group of traders through Robinhood started buying this stock. The stock went over $400. So the hedge funds, in order to cover their sales, had to buy the stock back at a higher price. And from what I understand, they lost about $4 billion. So these young traders are going after the hedge funds. So it's quite interesting what's going on out there. Too risky for what we're talking about tonight. So
my question to you is, how does these traders, millennials,
well,
let me just turn this person off. Okay. How do they know which hedge funds to go after? Is this part of public news?
yeah, you can go on Reuters. You can look in the in Barron's or the
Okay.
Journal. You can see all the shorts, what we call the shorts. Yeah.
Okay, okay.
Yeah, it's that information, because when you sell and you short like that, you have to announce it to the SEC,
Yes,
and it becomes public knowledge. The problem with, and this might be a little too complicated. Let's say you own a brokerage account. You want to buy a certain stock, and you don't have enough money to buy it, but you're really adamant about buying it. We will loan you the money to buy it. And you would hope that it would go up and pay us off with the increase. Now, if it goes down, you have to continue putting in money to support that trade, which we've loaned you on. Now, and in order for you to buy it, we have to loan you the stock. What the hedge funds do, since they are so big, they don't have to go out and get a loan of the stock by a brokerage firm. So when they sell a stock, they sell it and they don't own it. they're selling it what we call naked.
Mm.
Because if you sold it, we would loan you the stock to sell it. And then you would owe it back to the company. So they sell without getting a loan of the stock. So when these traders went after the hedge funds, they didn't own the stock. They sold stock they didn't own. And as the price was going up with these other traders, they had to go in and buy the stock to cover, because the banks were after them and say, okay, you owe us this stock. And they were buying it at a higher price. So anyway, that's way beyond what we should be talking about tonight.
But the hedge funds took a great loss in those deals.
Yes, but I wouldn't cry over there. I'm sure they're still worth
They make
billions.
it up.
All right, so we talked about IRAs, we talked about 529 plans. We talked about investments. We talked about, am I missing a topic? I'm not sure, or if there's any other question.
Don't. Anyone else have any questions? Leslie. She's quiet. I know she had a bunch of questions about Robinhood.
Yeah, it's become a popular site, and only because if you own Bitcoins, it's difficult to buy and sell them, to get rid of them.
Uh-huh.
You know, if you own a Bitcoin online, it's an electronic payment. Where here they have sites, this Robinhood, that'll offer you Bitcoin that you can buy and sell.
I wanted to know, is there any particular like website or company that you would suggest to get children interested in investment?
Yes, I would, and my kids are at Fidelity. It's a reputable organization, obviously. There's no commissions on the trades, and you can buy 1 or 2 shares, and I believe even now fractional shares, without paying a commission. Their technology is probably superior to anyone else out there. So I would recommend Fidelity, yes. I move my children there also because there's no commissions. And they still use me as an advisor, but they're able to go online, look at their accounts. It's a very easy system, and it's reputable.
Mm. Mm.
And particularly for your children or your students, no commissions. And like I said, at a brokerage house, you wouldn't be able to buy 1 or 2 shares. Without even paying a commission. So there you can buy even 1 share. Let's say you just want to buy 1 share at this price of Amazon. You can do that there without commission. And they have a lot of information. Yeah, go ahead.
I'm sorry. That's up to like what age does that cover them? No commission.
Well,
18,
you have to be, you have to be 18 to open up an account. But what you can do is you can open up the account for your son or daughter. And then when they're of age, you can just transfer it over to them, their name.
Okay, I understand. Thank you.
Yeah. And of course you'd be using their money. Yeah, but that would be a good way. And like I said, you can, usually when I start children out and the parents will open up the account, you buy a stock they're familiar with, whether it's Coca-Cola or McDonald's or something like that, a name they know.
What about investing in the indexes like the S&P 500 or the?
Yeah, that's a philosophy. All right, I'll give you a statistic. Mutual funds are managed, right?
Right.
And their they compare themselves to the S&P index. 63% of the mutual funds out there in general do not beat the index. So when you pick a mutual fund, you really have to look at the manager and their history, not only in up markets, because everyone makes money in up markets, but certainly in down markets, and how they recovered from a down market. So the philosophy is, if you don't believe you can beat the market, the S&P index, you might as well buy the market.
Mm.
And the way to do that is the S&P index. So I have quite a few clients that only invest in indices, whether it's the S&P 500, an international index, a small cap index. Those are passive investments. In other words, no one's managing it. Whatever stocks are in that index are there for good. And you're basically buying the market without a manager because you believe the managers cannot beat the market. And if you believe that, you should buy the indices and buy the market.
Mm. Mm.
So it's just a philosophy, yeah. Most clients have both. They'll have they'll have a combination of mutual funds, stocks, and indices. So you can mix and match.
Interesting.
Let's see if I have anything hanging here.
Now, what?
I need questions.
Go on, guys. I guess this stuff is, some people do know a lot about it, and some people are, I know, just throw the stuff into the instrument and don't, and hope.
Yeah, I'm going down the list again, but I think we've
covered a lot of it.
I will mention that I know a lot of people are afraid to come into the market. And usually what happens in a downturn in the market, everyone panics and leaves the market. So let's say you put 10,000 in the market's having a severe downturn. You're down to 6,000. You panic. You tell me to sell everything, send you a check for 6,000. Well, that 4,000 is gone forever.
Yes.
I am a contrarian. I love bad news. Because for me, I have faith in the market and obviously the government. And what better time to buy a reputable stock when the news is at its worst?
Yes, because it's down.
It will turn around. And that's what happened the past, I guess, 10 years. You had a golden opportunity to invest in stocks from 08 and 09 that totally crashed. And you literally could have thrown a dartboard at any stock and you would be up almost tenfold today. And I start looking to invest when my clients call me and say, the government's going bankrupt, we're going under. And at that point, it's gone down more than it should have, because if you look at the news sometimes, the stock programs will tell you what the value of the market should be. And if the value, let's say, of the market should be, or the S&P, and they do it by earnings, should be 20 times earnings, and now the S&P is only 10 times earnings, well, you know it's time to go in. And when I start hearing everyone panic, that's the time you should go in. But it takes a strong individual to invest when all the news is negative. And most people won't. They'll wait till the market turns around and then it's too late. So the market is a tough cookie. You have to be willing to take a lot of risk, knowing at some point your portfolio will go down. But over time, it always rebounds. The market, when it's, you have to remember with any stock, there's a growth factor in that price. So the firms will come out and say, we expect to grow at 10% a year. That's factored into the price of the stock. Now, if the firm comes back and says, well, we didn't hit the 10, we hit 5, well, that stock price has to come down. That's what happened in the 1999, 2000, the dot-com era, where firms were saying we're going to grow at 50% every year, and they did for a couple of years, and all of a sudden it came down to 10%, and the market crashed. And over time, a normal correction in the market, and it's healthy, is a 10% downturn. So the Dow Jones is at 35,000 right now. If it goes down 3,500 points, that is healthy. That is a correction. It's not a crash, because the market determines at some point we're way ahead of ourselves. We need to come back, and it comes back to a level that it should be valued at. It becomes the new base, and from there it goes up. So people even think that, when you think about it, even these days, if the market goes down 1,000 points in one day, divide the 1,000 by 35,000, that's minimal percentage. Years ago, a 500-point return was a disaster, because the market was only 800 in the Dow. So 500 divided by 800. So, and you always have to remember there will always be at some point a correction, because the market has momentum and it goes past where it should be.
Is this okay? Sister Lane is asking, is this the Buffett? But she says, is that a Buffett philosophy which works for?
I'm glad you brought that up, because I have a lot of clients that want to know what Buffett is buying. And they always lose money. And the reason is Buffett looks for firms that have substantial cash flow. He is not interested in buying a firm and the stock goes up double. He is interested in cash flow. So even though he does have a good portfolio, and yes, you should hit one of his philosophies. Yes, if you notice, he will go out and buy firms when the market is down. So basically that's his philosophy, but he's more looking at the cash flow of the firm that he can generate and come into his company, rather than, and yes, he's looking at a good price. So yes, when the market is down, he will look to buy a company, but his main concern is cash flow. He will not buy a company that doesn't have a sufficient amount of cash flow that he can take internally within the company. So you might buy his stock portfolio and try to mimic it, and it's not doing anything, because his major concern is not the price of the stock, but the cash flow and earnings that the company generates.
Can you speak a bit to the put and the call options?
All right, we're gonna get a little complicated. All right. You technically, if you want to own a stock and you can't afford it, you can go into options. And let's say, all right, let's say a stock is trading for $50. All right. You can buy an option to buy the stock at, let's do it at $50. And the reason you won't execute it or exercise your option to buy the stock at 50, because there's a premium to be paid for that option. So let's say you pay $1 for the option. So now your cost, if you sell it or you exercise the option to buy it at 50, you're going to buy it at 50, but you've lost $1, right? So what you would do is you would buy a call option if you think the stock is going to go up. and that would be the only reason to buy it. If you think it's going up to $55, so you buy an option to buy it at 50. All right, and it goes up to $55. You don't have to literally buy the stock. You can sell the option at $55 and make a $5 profit.
Mhm, mhm.
So for those who want to own like Amazon and can't afford to pay, what is it, $3,500 for a particular stock, you can buy a call option to buy it. And if it goes up, you just sell the option back at the difference between the price. A
And-
put option,
Go ahead.
okay. A put option, you would buy a put to sell at $50 because you think the stock is going to go down. So if the stock goes down to $45, you have an option to sell it at 50. So you still make a $5 profit. So you sell the put option and you get the difference of the $5. So you technically, the option market, they don't own stocks. They are looking to profit on the difference in the change of the stock. Now, obviously, if you have an option to buy a stock at 50, to buy it at 50 and it goes down to 45, you can't sell that option because it's worthless.
Right.
Who's going to buy an option to buy it at 50 when you can go into the market and buy it at 45?
Right. Right.
So that would be for those. And it's also a hedge. Let's say you own the stock and you want to hedge the downturn. So let's say your stock is trading at 50. So you would buy a put to sell it at 50. And if it goes down to 45, you can sell the option at $50, all right, and gain the $5 profit. So a lot of firms use options as hedges. Now, if it doesn't do anything, you can think of an option that way as insurance on the stock you own. So if it doesn't pan out, you've just lost the price of the option, which might be $1 or $2.
Okay, very good.
It's basically insurance.
Okay, okay. Are there any more questions for Robert? We're just a little bit over. And
That's
Robert,
all
I noticed you didn't drink
wait,
water. We have another question. Go ahead.
Oh, this, I can't read it all. What does
It
it say?
says, thanks for the explanation. This Robin online trading, is it risky? Well, what isn't?
Yeah, well, you don't have to, if you use Robinhood like Fidelity or anything, and stay away from Bitcoins or these NFTs now that they're talking about, you can just use it as a regular trading program, platform. You don't have to go into the only reason they're at Robinhood and it's so popular is because all these young, I don't even know if the young ones are millennials. The young one, no, it's a different generation. They're just hot on this Bitcoin stuff.
Uh-huh.
And it was difficult to buy and sell Bitcoins without owning them directly. Now you can go into the Robinhood platform and just buy and sell, like you would any other stock. That's the only reason they're there.
Interesting.
Otherwise, it's a regular trading program for stocks. But I prefer Fidelity. They've been around for ages. Their platform, technology platform, is probably the best. They're reputable. As you know, they're sponsors of 401k plans and everything. They've been around a long time.
Yes, yes, yes. Are
So I
there
think it's
more?
safer.
Yes, thank you very much, Robert. Are there any more questions tonight before we call it close?
I just have a comment. I think earlier I heard someone talking about, our children, the young, trying to kind of like, how do we start them off with investing, money management. And one of the things that I try to do with my kids is to keep it very simple, is to, money management, I think, is a mindset, and is to try to create the mindset in our kids and our youths So for example, my kids love to eat at Chipotle,
Yeah.
and so for them it's busy, so what I do is I buy the stock because they could understand that every time they go to Chipotle, that they're making money for themselves in the stock.
Yes.
So just basic things like that to help them understand the mindset of being that consumer to owning something that is going to make you money, whether it's the sneakers that they like to spend money in. Well, maybe you might want to invest in Nike. Let's look at, study that stock and see how it's doing. So I think it's just very important, as parents, especially, to start helping our kids to develop the mindset about, being a consumer versus, trying to invest and making money. One of the biggest lessons that I've learned when my first job was at 13 years old, when my mom told me that, I made $15 many years ago. I'm not going to tell you my age, but it was a long time ago. And she said, what you're going to do with your $15 is first you provide tithes. She taught me how to do the 10% tithing. She said, then you save the 20% and then you spend, and you could buy whatever little things that you have. And I kept that concept in my mind, throughout, my life. And I have business degrees and all that, but honestly, it was that basic concept that really helped me in life. And of course, later on, learning all the things that you've talked about, Robert. Thank you so much for all the
Yeah,
information.
and everything you said is true. Yes. And hopefully even when they own the stock, at some point it goes down a little so you can show them that there is risk involved, and they learn all this. Yeah.
Yeah, exactly.
Yeah. And I do like you do, I'll ask them, what do you drink? And they'll go Pepsi. I go, okay, let's buy Pepsi, or McDonald's, something they're comfortable with. Yeah.
Mhm.
But Robinhood is out of control. These kids, and they're between 20 and 25. They're just out of control. And I wonder, like I have some clients, the parents call me and they say their children don't work and they're on the Robinhood and they're working with buying and selling Bitcoins. And I say to myself, sure, they're making money now, but shouldn't they be looking to find a job?
Mhm.
None of them are working. And I don't know if this is taking away, and at some point it will implode. And I don't know if it's taking away from them actively, because looking for a job is a full-time job, actively taking them away from doing that while they're making money, such easy paper money, trading all these vehicles. So anyway, just a thought.
Thank you, Robert. Are there any more questions out there? Well, I want to thank you sincerely, Robert, for taking your time and bringing to us some of your expertise over the last couple of years. And if there
Well, a lot of it is luck. I could give you all the reasons why we should buy this stock, and this has happened, and it goes down. And I haven't got a clue when all the numbers are there, the news is there, and it goes down. There's so a lot of it is luck. Also, we can only go so far. But I want to tell you, Carol, if anyone has,
there's one more question.
Sure.
And this is from Leslie Coster. How do you move substantial investment out of the account with the least amount of loss at 60 years old? No microphone to speak.
Okay. Well, it depends what type of account it is. If it's a taxable account, you have to remember if you have a stock portfolio in a taxable account, you only pay taxes when you buy or sell. When you sell, if you sell at a loss, you actually have a tax benefit because you can declare the loss on your tax form. But if you have a gain, you're going to pay taxes. If you trade, and that wasn't the original intent of an IRA, if you trade within your IRA, if you constantly buy and sell within an IRA, nothing is reportable. The pro is that if you have a nothing but gains, you don't have to report the gains. But if you have losses, you can't take benefit of the losses. You can do it within an IRA without any tax effects.
What she's saying here, investment, she's invested in Vanguard. It is a stock-only portfolio, and the account has been held for a good 10 years, and it's not an IRA.
Ooh,
So she
okay.
wants to basically know she's made, quite a bit of money here, and she wants to be able to take it out without without Uncle Sam, hitting her very hard with the taxes.
Impossible.
Mm.
I am in the same situation.
Too much
With a few,
blood loss.
yeah, with a few of my stocks. And literally, if I sell them, I'm going to get killed on taxes. There's no way around it. If it's in a taxable account and you sell, the firm Vanguard will report the gain or loss. Let me see, how long-term? Yeah, that's fine. So the tax rate will be lower on a long-term investment than a short-term, but it will be taxable.
Is the age, since she's 60 years old and so she's past the 59 and a half, she would just use the 10% penalty and then just have to
No,
pay.
no, it's not in an IRA, it's in a
Oh,
tax.
it's in a taxable.
So it doesn't matter what your age is.
Can she move it into an IRA not to absorb some of those penalties?
No, you can't. You have to move cash into an IRA. But
That's exactly the question.
the only way around it is to donate it or gift it into a trust, but then it's out of your control and you have no benefit.
Or what about buying a house, she says?
It doesn't matter. It's taxable. You will pay the taxes first before you buy the house, because you're not transferring from one house to the other. There's a like in kind transfer as far as real estate is concerned, but there's no way around it. If it's in a taxable account, when you buy or sell, it's taxable, and the firm will report it to the IRS, so you will have to put it on your tax form.
Report it once she pulls it out.
No, report it once you sell it.
Well,
doesn't
yeah,
pull it
sell it,
out.
pull it out, yeah.
She can leave it in there.
Okay.
That's why a lot of my clients, they're fortunate, a lot of their money is in the IRA and they'll do the buying and selling inside the IRA, but when they have a loss, they can't take advantage of that either. Yeah, you never get away from paying income tax, even in death. When you pass, you have to pay, if there's a state you're in, estate taxes, but you always pay income taxes, even in death.
So she has another question. So
Sure.
should my money making focus be more on my IRA?
Well, if you have the money to do it, yes. If there's enough money inside the IRA. But if she's already, I see she said with her Apple stock, and ironically, I have the same stock in a taxable account, I'm afraid to sell it.
Yikes. And didn't they just have a 4-to-1 split?
Yes.
Yes. So that's
But the value was still there.
okay. Okay. All right. Yeah. And last August they had a 4-to-1 split.
Yeah, but
okay.
Yeah.
Uh,
Never going to get away from income taxes.
yeah. Are there any more questions? Leslie, thank you for those questions. Annie, thank you for.
Well, luckily, it's a good position to be in, right?
Yeah, it's a good position. Exactly. Are there any more questions out there? before we wrap this up?
Yeah, that's right. There are worse problems. to
There
have.
were problems to have,
Well, yeah,
correct?
if there's any questions after the fact, pass them through Carol, and I will be glad to get back to you and answer them.
Thank you very much, Robert. Thank you for your time. Thank you for sharing your expertise with us. And so we will wrap up. Pastor Taylor, are you there to close us in prayer?
Yes, I am. Okay. And again, I'd like to thank Robert too. It was very informative. I was thinking about the educational plan. My son actually has a good plan for his children. He says, just go ask their grandfather.
Not uncommon, not uncommon. I'm in the same situation.
Okay. All righty. So let's just close out with a word of prayer. Yeah? God and Father, we just thank you for this session. It was profitable, informative. We just thank you for Robert and his willingness to come and inform us about so many things. So we just pray that this will be an ongoing conversation. We ask this in Jesus' name. Amen.
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 Thank
Yeah.
you all for joining and send your
Any
questions.
follow-up questions, pass them through Carol, and I will be glad to answer. Yes.
Thank you so much, Robert. You have a wonderful evening.
So Carol, what do I do
Thank
now?
you.
Do I just,
You just stay. I will just end the call. Leo and Stephen, thank you so much for your technical help this evening. Much appreciated.
Okay.
okay.
Okay, good
Good
night
night.
all. We're gonna close
Good
out now.
night.
Good night.
Yes.
Thank you. Good night.
Good night.
Bye-bye.